Well, this is the first episode of Ridiculous. Today we're going to be looking at today we're going to be looking at Algoma Central, which is a Canadian Great Lakes shipper. So let's see here. So they basically move cargo along the Great Lakes, which some have described as Highway H2O. Let's see here now. So the reason why we're taking a look at this is it on the surface does not look expensive. And what does that mean? Well, it's trading for like 5 times earnings. And they're making money. So they're profitable. They are, and it's a service that you need. You need to move cargo along the Great Lakes. There's no way to move things like grain or steel or coal or whatever from from the ocean into the interior of Canada, the United States. So that is one of the benefits of this business, is that really you're probably not going to see an alternative. So Algoma Central ticker is ALC.TO. So it's listed on the Canadian Stock Exchange, Toronto Stock Exchange. Okay. Current market cap is roughly 550 million. Headline P ratio is 5.5 times. Dividend yields about 5%. And if we look at Seeking Alpha, the last article published was in 2018. So it is safe to say that absolutely no one is looking at this, which is good. Daily volume traded is about 7,000 shares, and the price is 14. So what is that? Somewhere like about 100 grand Canadian a day traded. Okay. So first things first, let's take a look at a longer term profile. This company's been around for a while. They are not new by any stretch of the imagination, which means that there's the benefit of having a lot of data in terms of their financial performance, which you want. The shipping in general is typically not a great business, but this is sort of like kind of short. This is not like sort of reminiscent of like kind of short haul trucking. Like there's a limited amount of traffic that can be done on the St. Lawrence Seaways, and there's really not much more to do. Algoma Central fuels domestic product tanker business, 127 new build investment partnership with Irving Oil. Yeah, so they also are doing some partnerships with a bunch of different. So they're trying to expand. It looks like they're trying to expand beyond St. Lawrence Seaway, which is good because there's only so much trade, and I believe that they are the largest shipper on the St. Lawrence Seaway. We got here. There's a strike I'm pretty sure there's a strike. Loading hours before strike. Okay. And here we go. According to the St. Catharines Standard, reputable newspaper, Seaway strike comes at a worst possible time, says President of London Commodities Agricultural Commodities Exchange. Right. Strike is employees happen at a worst possible time. Buy and sells. Canada, U.S. Okay. Creates a quota. Okay. So what is this strike? $20,000 tons soybeans bound for global markets to be loaded. Short tons. Okay. Okay. St. Lawrence Seaway strike. Okay. What does this say? "360 employees with the government-established company have been on the picket lines since Sunday after negotiations broke down." St. Lawrence Seaway Management Corporation. Okay, so the St. Lawrence Seaway Management Corporation, I suspect, manages the St. Lawrence Seaway. They probably deal with all the locks and stuff about us. What do these guys do? Great Lakes St. Lawrence Seaway Management was built as by national partnership between U.S. and Canada. Administration of the system is shared by two entities. Blah, blah, blah. Okay. Construct, operate, maintain part of the St. Lawrence Seaway for transportation. Okay. So it's a U.S. Canada government body that essentially manages the Seaway. And they're on strike because they're unionized by Unifor. Okay. So obviously every day, like there's not a lot of extra capacity. So every day that, plus you're in harvest season for grain. So every day this kind of backs up. You are eventually, eventually the system just backs up, and the farmer's got to leave stuff in the field. There's not enough storage. Truckloads of soybean harvested by local farmers continue to be delivered to the port. Approximately 5,500 tons every day stored inside grain elevators. Wow. So ships are typically scheduled to come once a week to load and deliver the supplies to buyers, which in turn creates more. Okay. 125,000 tons of soybeans are yet to be harvested. Okay. No back to work legislation, so that's not good. Basically, these guys strike. The strike continues. Then you can't load ships, can't make money. It's temporary, but you're going to take a bump in at least fourth quarter for sure. I have to suspect. These continue to urge both parties. So, we're talking about Algoma Central. This is they do lake shipping along the Great Lakes. All right. What else? Algoma. Let's see if there's anything specific around Algoma. Nope. Can't read the article. All right. The full Great Lakes St. Lawrence System Seaway, known as Highway H2O, serves over 100 ports and commercial docks, and helps Canada's Prairie province in the U.S. Midwest export goods. Grain, iron ore, petroleum, stone, and coal are among key commodities. Okay. So you're basically taking heavy shit from the middle of the countries out to the ports and docks along the way, and probably to the ocean as well. Algoma Central, the biggest domestic, so the Canadian domestic ship operator on the Great Lakes, has said many of its ships are now docked, waiting to haul iron ore to mills in Hamilton, where it'll be turned to steel for the auto industry. Okay. Got it. The Seaway shutdown is costing the economy roughly $100 million in lost revenue daily. That's a lot of revenue. Okay. All right. Okay. All right. So let's look at some financial data just to get a high level and see what these guys have done over the last so many years. Okay, 2022 revenue 677, 942. OpEx 90, 44. Operating earnings. Net earnings 19,966. Okay, so on the surface, their revenue net income profile is going to be skewed by their joint ventures. So it looks like, just based on the face of the financials without doing any actual reading yet, is that they have some JVs. Don't know, so that's going to be important to look at because they produce and import a lot. So of the 120 million, roughly, approximately, in 2022, 35 million net came from investments in joint ventures. So that's pretty significant. What does the balance sheet look like? What does the balance sheet look like? So we got cash. Holy shit. Okay. So this thing is trading below book value, like considerably below book value. So book equity, 726 million. Market cap, 550. So it's trading 75 cents book value. Could be good reasons for that. Apart from the slowdown in earnings, you also have the fact that you also have the fact that interest rates are up significantly. So you also have interest rates up significantly, which means when you have big assets like this, typically that have debt, they have some debt, about 400 million, which is not. Man, these guys are conservative. It's awesome. You have 400 million on an asset base of 1.4 billion. Okay. Okay. By the way, we got a little disclaimer. This is not investment advice. We are simply here to entertain, maybe educate, but do your own research, do all your own stuff, do all your own work. Don't rely on us to do your work for you. We might make mistakes. We might be wrong, etc., 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 etc. So, yeah, big disclaimer. Okay, back to what we're doing here. So these joint ventures look pretty profitable so far. How much do they make from these joint venture earnings? Earnings from JVs. So like I said, they made about it's just like you got to look beyond the surface of the financial statements, but and this is the thoughts that you want to be having when you're going through this. To start with, they've invested, per the balance sheet, about $200 million in this JVs 2022. We'll look at 2023 soon, but start with the full year financials. $200 million, $209 million, whatever, call it $200 million. And they earned net earnings $35 million on $200 million investment in shipping. That's good. That is nothing to sniff at. Conversely, in the prior year, it was 18 million on 155 million of asset. So they are, again, it's on all surface level. Shipping is cyclical. You really can't, you can't just be like, oh, that looks good, and buy it. No, that's crazy. There's going to be probably a myriad of things you got to consider. As well, shipping is very heavy CapEx, very heavy. These ships are not cheap. So you also got to be prepared for that. To that investment, you got to replace that stuff. These things don't last forever, right? All right. So what are we doing? We are simply going through and entering some key data. What kind of key data? Sales, some key costs, key numbers on the balance sheet, this kind of stuff. Just to get a high level sense of the company, what they've done, etc. Why are we doing this by hand? 2 reasons. One, in general, you can't really get great or even good or even good like data, particular data that you want. If you want specific data, it's not going to go to some website and just going to be there. And most services, you talk Yahoo Finance or whatever, all the free stuff, they'll give you like common size financial statements, which is like they'll give you sales, right? But what if the company has multiple like different types of products they sell, and each of those, and like which could be significant. So you never really want to just be like take what's on the surface. It is not advisable to do that. So it takes a little longer, but totally worth it because you will have a better sense of the actual company. For buying the financial situation, and not only today, but going forward as well. So, pretty important. But it is time consuming. Well, part of the job. Incidentally, you will learn a lot. Like if you do this well and diligently, you will actually learn a lot about the businesses that you're looking at, which is good. You should be curious about the businesses. You shouldn't just be looking for, some sort of formula to get money, which is what you want. It's important to make money, but obviously, why are we doing this? But you want to maintain a real. You gotta be curious. You actually gotta want to know what's going on. That's the only way you'll actually push for getting to the truth, getting to the answers that matter. Otherwise, it'll just be, kind of bumbling around, doing whatever. All right. Okay, so I guess they haven't released Q3 yet. It's only Q2 is the most recent data. The data. Okay, 6 months into June. All right, no big deal. So that strike sounds like it just started, which means Q3 will not be reflective of the strike earnings, but I suspect that management will talk about it on the call. You'd be hard pressed for them not to, I think, right? Because sounds like a pretty meaningful event. You stop shipping along the crazy. You can no longer transport goods, and your business is transporting goods. That's kind of important. Kind of a big deal. All right. What does our TTM situation look like? So last 12 months revenue, TTM revenue, TTM June. Okay. Okay. So profits pretty stable, for trailing 12 months. It's like a cash flow. Profits pretty stable for the last 12 months. Down, but not too bad. A lot of leverage in shipping, so when stuff goes, it's a heavy asset, big capex, right? So when something turns down, it's usually turns down pretty quick. Uh-oh. Did I miss something? We missed something. Ah, yes. Okay. Interesting. See, this is why you learn stuff. So if you look at their financial statements, they separate, the company separates additions to PP&E, which would otherwise be thought of as CapEx, and additions to vessels under construction. So they separate PP&E differences from boats they are building. That's important. If you were to look at, say, a high-level number, you might not get that, right? If someone just said, hey, here's the CapEx number, and they only pull the additions to property, plant, equipment, you might not get the additions to vessels, which is also CapEx, longer term. If you're building a ship, it takes, it's going to be around for 15, 20 years, useful life or whatever. Making up numbers, of course. But it's going to be around for a long time versus if you're simply buying office furniture, right? Yeah, it's a big difference. But you might not get that. You might not get that. You might not get that if you just look at the high-level stuff. So always look at this source, and you will avoid certain problems. Not every problem, but you'll avoid certain problems. What else they got? All right. Distributions. So one thing to note about joint ventures, the way the accounting works, you report the earnings, but that's not exactly how the cash flow works. So, and well, we haven't looked yet at the details. Investment. Well, we haven't looked at the details it is not necessarily the case that you know that you will be told where the earnings are coming from. So, like for example, let's say they sold an asset in the joint venture and they had a big gain on that asset sale, right? Okay. Well, you might, if all you see is the earnings from said joint venture on the income statement, then you might conclude, well, that's a not a one-time deal. Depends what the company discloses to you. You might have a chance to know, but it's obviously not recurring in that case. I'm not saying this case here, but I'm just saying in general. This is something to consider. So on the cash flow statement, they have distributions received from and cash invested in. So how much money in cash was paid from the joint venture to the company, in this case Algoma, and how much money did Algoma put into said joint venture. So those cash flows are important to take note of because you could have all these earnings, but the cash flow statement might show that, well, you're also pouring in tons and tons of money. It might be fine if they're investing for growth, but there's always situations where you could have earnings being derived from things like one-time sales of assets, which are not recurring, and cash being consumed by recurring things like operations. So, it's not always the case that one by definition equals the other. So, anyways, things to watch out for, things to be careful for. Uh, so if this is, all right, here we go. All right, so we're back on track. Let's see here. Where is the working capital? So some companies don't break down the change in working capital quarter to quarter, or on the facial financial. You gotta look at the notes. But in this case, in the quarterly, they obviously don't break down. But you can do it from the balance sheet technically. It's just might not always be perfect. So it's kind of annoying. It's not the end of the world, but it's kind of annoying. Right? I mean, you could do it all, just do it on an aggregate basis, but you missed the nuance. Details matter. Details matter. Details matter. So far, nothing wildly exciting. In terms of, exciting in the sense of, so far nothing's blown up, and it's kind of still just sort of, you always try to reserve your opinion until you've completed your diligence. It's easy to get excited. If you get too excited, you sort of start to gloss stuff over. Well, you start to ignore kind of red flags that you do come up against because you're excited. So we definitely are of the view that it pays to be slightly more boring in your assessments whilst you are doing your assessment. You'll be well rewarded if you just be a little bit more, you know, blasé about it. You never want to try to convince yourself that something's a good idea. Should be a good idea, and therefore you are convinced, not the other way around. Right? It's a big difference. Okay. 3 years down, a whole bunch more to go. Yeah, and once you get the first few down, you start to get a feel for um, their financial statements, how they work, and all that kind of stuff. And people might say, "Yeah, this is really time consuming." Yeah, it is. Yeah, it is. Super time consuming. Is it fun? No, no, it isn't. It's not the fun part of the job. It is the necessary part of the job. But, and arguably tells a story. Like, I think this one people thing that people sort of maybe forget is that the conclusions of the story of the company are all written in the financial statements. Everything ends up there, ultimately, right, over time. So every bad decision, uh, every loss, everything the company has done, or at least the results of everything the company has done, all ends up in the financial statements. So starting there at least grounds you in history. It's not the future, and all you as an investor get is what's coming down the pipe for the future. So you got to make sure not to anchor yourself to history. Say, okay, well, what's coming next? But it sure helps to be grounded in history, so you can understand where the company has been. And a lot of companies, let's say the management has been around for a while. Well, what have they actually done? What's their actual track record? That's important to know, because very often management, particularly CEOs, are good salespeople. Often how they got to be in the job. So, you run the risk that you get sold, quote unquote, on their business versus going, what is going to happen to your money? How much money, cash, is going to come out of this business? Right? So that's what you need to be thinking about. But you can easily run the risk of getting sold on something because it's easy to be optimistic about the future if you're trying to sell something. And nobody likes a sourpuss. But sometimes, as an investor, you got to be a sourpuss. That's how you stay safe. That is how you stay safe. So the company's, like pretty consistently profitable, right? Like it's not even profitability. It is still shipping. So you shouldn't expect that to be the case. But you know what? It's not like they have these or at least in the last, you know, 5 years or so. You're not getting these dramatic blowout years where there's huge volatility in earnings or cash flow, right? So there still are a good, you're not going to get the massive ups. Doesn't seem that way, but you're still getting good returns. So these joint ventures they've had for quite a while, at least since 2018. So it's not a new feature, but it looks like they've been recently very profitable. This is another thing too, right? So if you see that number and you're like, wow, these joint ventures are awesome. Well, historically, at least 2020 to 2019, you lost money. Maybe you got some, you didn't really get any cash or earnings out of it. So, if you only look at near-term results, it's not going to be, it's going to be misleading, or at least it's not going to highlight for you the volatility in the results, which is important to note. Yeah, businesses work overtime, right? Overtime is when things happen. Let's see here. Investment joint venture. Yeah, and you also get to see like what happens over time with some of the key amounts, right? Like, are they getting more debt? Are they getting less debt? Are they paying debt off? Right? Are they building up equity? Are they not? Why? Like in this case, equity in 2018 was 700 million. In 2022, it's still 726 million. So, and let's see, at the end of the second quarter of 2023, it's 720 million, right? So, what is driving that, right? Like, why isn't your equity account growing? Right, so you're paying out dividends. That makes equity account not grow. Maybe they're doing share buybacks, right? If you see the equity account not growing or changing in a certain way, that's weird. Or not changing, which you would like if you're having earnings, but you're not getting any equity growth, then chances are something is happening in the capital side, right? That's annoying. That's annoying. Okay, another tip. So in the cash flow statement, and this is really annoying, interest paid on debt is in financing versus being in operating cash flow. That is annoying. That is super annoying. So basically, you have, again, it's not that they're doing anything wrong. It's just that if you think about interest being paid as an operating cash flow, which we do, because I think it makes sense, then it should be an operating cash flow. You're paying it at operations. It's an expense. Then you're going to miss that if you don't sort of do your own reclassification. Another reason why it pays not to just look at sort of high-level financial statements like in Yahoo Finance or whatever. Because if you want to look at operating cash flow, if CFO is what you care about, you should care about that, you will totally miss interest, even though they have a lot of debt. So you'll think that their operating cash flow is much higher than it actually is. That's bad. So again, we recommend look at the actual numbers. Look at the financial statements. It's useful. It is very useful. Right. Uh-huh. Well, they haven't been buying back stock. In fact, they issued a little bit, probably from they issued more. Yeah, so share count is actually increasing. Which is the question is, why is it increasing? If they're doing it to fund assets, okay, it's not terrible. If it's all from stock options or whatever, then it's not great. You're basically paying employees with owner capital. That being said, it sort of went down and back up. So it's kind of level over the last 5 years. Fine. So we'll have to look more into that. So it just means you gotta look more into it. When you see stuff like that happen, it just means you gotta look more into the reasons. Right? When you see sort of odd trends or whatever. Just means you gotta look into the reasons as to why something is occurring rather than jump to conclusions. Just look at the reasons. You know. so I'm interested to see whether these JVs are actually working because they seem quite valuable. They seem quite valuable. It'd be interesting to know, apart from just the financial returns, like what the strategy is, right? Why are they using these JVs? What are they doing with them? Are they getting exposed to new products? Are they getting exposed to new services? Are they partnering with someone that they can learn from, etc. Okay. How many years of data do we have now? 1, 2, 3, 4, 5. Okay, a couple more years, then we can start actually reading. So it looks like in 2017 they had some discontinued operations, so they either sold something or folded something. Bears looking at. Okay. Now you can't do this level work on everything. It's just not. It is not practical. So it has to look on the surface. The company has to look at least. You have to have some kind of idea, something that reason says like, okay, I need to look at this for a reason other than whatever. In the case of Algoma, it looks on the surface cheap, right? Trading below book value, it's profitable, right? So it's one of those ones where you go, okay, I'm willing to listen, and the work you do now doesn't get wasted. So let's say you do all this work, and you're like, oh, it's not good, can't buy it, can't do it, can't make money off it right now. It's not the worst thing in the world. It's not great, but it's not terrible because all this entering of data, as long as you don't delete the Excel file, it's gonna be there. So if you come back in the future, go, oh, I remember this. You already have a huge head start. So over time, this is going to compound in your favor. You're going to get to know companies a little better. You're going to get to see a little more. Right? You're going to have data that's already set up, et cetera, et cetera. And that's going to help you. That's going to make your next, that's going to make the next bit just faster. Next time you do it, it'll just be faster. You won't have to redo all this stuff. You just update whatever you did before. Yeah, so these joint ventures, historically, they haven't produced much. So between 2016 and 2020, literally produced $2 million. But they had invested like $150 million, right? So on our earnings basis, they produce very little. And what I think is instructive is on a cash basis, it produced. Oh, wait a second, hold on. Joint venture. Yeah, so these joint ventures, remember you can get net earnings, but you you can't just look at the cash flow. You have to look at both. Because if you just look uh, at earnings, then you might be fooled. And if you just look at cash flow, you might be fooled as well. The reason is for cash flow, particularly with heavy assets like shipping, depreciation is a huge amount. So it might just be the case that what you're seeing from a cash flow statement is just return of capital, just getting your money back because it's depreciation that they're paying you out versus actually earnings. So the earnings are going to tell you, okay, well, how much are we earning on our investment? Whereas the cash flow, that's important too, because you do actually want your money back. If you put all this money in and you don't get any money out, well, that's an even bigger problem. So at the very least, you want your money back. So that's why, yeah. So when you're looking at joint ventures, which could be tricky to assess depending on the information that's available, sometimes you might not be able to assess it very much at all. Something that's meaningful. It also means it skews the margins. Like, let's say, like shipping has weird margins, but like, let's say you're looking at, I don't know, automotive products, automotive manufacturing, or whatever. Pick an industry. Well, they you might have a situation where revenue is very high, a lot of revenue for a company, and you might have this earnings from joint ventures, but those earnings are small relative to revenue, but high relative to overall earnings, which means that it looks like the company is much more profitable than it is on a margin basis. But those are just simply being inflated by this because you just see the net earnings from the JV. You don't see any revenue coming in through the income statement. So you could be fooled that way on the margins. If you just look at margins, high level, right? See how that works? And there's a lot of different types of things that give you this sort of false sense of margin, because there's either no associated revenue, or it's like the revenue is not always connected to the earnings, which is, I think, the key thing people sometimes forget, particularly if they're looking at the high level financials. If you have a small piece of the business that's very high margin, extremely high margin, and a big piece of business that's extremely low margin, on a blended basis, you might think, well, this business is doing okay. When you actually start looking at it, you go, well, actually not. And the reason not, because one part of the business might be doing very well. The other part of the business might be doing not so well. And your analysis has to sort of parse those out. And that's not easy if you only look at high level stuff. In fact, you can't do it if you only look at high level stuff. It's not just not easy, it's just you can't do it. All right, we are nearly done. We are nearly done. If you're wondering how much data you should enter, generally speaking, you want to cover a cycle for a business. So whatever that means for that business, if it's 5 years, 10 years, whatever you think is a reasonable time horizon. Longer is usually better, but not always better. Usually, but not always. Sometimes looking too far back is no good, because you're looking at information that is just now at this point totally irrelevant. And usually looking too short can lead you astray, but sometimes not. Sometimes sometimes looking too far back is also, even at a reasonable, let's say 5 years or 10 years, which is usually pretty reasonable. If you look too short, maybe the business has changed dramatically, and you're going to miss that. If you look at, well, last 10 years not good, blah blah blah, but maybe this, sure, they've had a quote good year, but maybe that good year is actually the thing you got to be focused on, right? Maybe that's where the business is actually headed. You want to be where the business is actually headed, not where the business has been in the past. Go to where the puck is going. Okay. So again, just based on the financial statements, just the surface level, those joint ventures ramped up. It started around 2014, 2015, and they ramped up since, pretty much, in making investments in it every single year. So that's like, you don't have to read anything to know. It's just, there it is, right? Here's when the money. And they might have been doing stuff in the meantime, so you can kind of, but exactly when it's like when does it started. You can just sort of, you see it. It's clear, right? If you don't, but when you're putting money in, it's right there. So stuff like that's good to sort of pull out. Kind of gives you, again, just a flavor for the history. And then you gotta dig more, right? You gotta do more. There's obviously a fine balance between doing enough work and too much work. You cannot spend all your time on one company. There are many inefficiency. But once something looks good enough, then you got to sort of, you know, bet your time first on doing the analysis. There's no point rushing into something that's terrible, right? Why would you do that? So it also means that you want to look for stuff that you don't have to sell quickly. Oh my God, imagine doing all this work and then like next week you have to sell. Kill yourself. That's terrible. That's terrible. So ideally, what you want is stuff that you can do good diligence, understand it, and then not sell it for like a long time, if ever. Ideally, you wouldn't have to ever sell it, and then the business just grows, and you just grow along, and your investment grows along with business. Now, that's the ideal scenario. Very often does that not happen. Like that frequently doesn't happen, but that's what you would, in an ideal world, want, because then you just get all this leverage on your time, right? You don't have to. Moving capital around takes time. That's the short answer. Moving money around takes time. If you don't have to move money around, you save that time. You don't have to spend that time. And so you get leverage. But if you're constantly moving stuff around, money around, oh my God, so much work. So much work. It's terrible. All right. Okay. 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 So that's it. So it took us a long time. But now we have it. Now we have it forever. Oh, whoops. All right, let's see what else. Yeah, so no distributions. Right, okay. All right, let's see what we can see. Okay, so keep in mind, this is lake cargo shipping, not not AI driven whatever, right? Lake cargo shipping. Revenue has grown about 4% over the last decade. It's good. Share count is roughly flat, but it's been up and down. So they bought back shares and they, I guess, issued more. Cash flow has been solid. So they've driven all the cash effectively back into capex, which means what? Which means how? Okay, so what have they done for dividends, and share buybacks? All right, so we're gonna add some more data. Why are we adding more data? Because we have questions. When we looked at the amount of cash the company generated, it's about a billion change. They basically spent it on no, about a billion. They basically put it all back into capex, ships, and basically capex and ships, mostly ships, which is fine. They're growing the business. It's good. You got to replace ships too, but they also got to pay for dividend, right? So the question then becomes, how do they pay for the dividend if all the money's going back into the ships? Now, they do have debt, and that debt has gone up over time. So there's little bit of mental math, right? Like the company could, in theory, just put all the cash back into assets and give shareholders nothing in the interim, and they would have no debt. Okay, but obviously the business is consistent enough where you can give shareholders, if you're an owner, you'd like to see a little scratch in the meantime, right? You'd like to have a little, and shipping. You can think of it on a ship by ship basis. So it's like if if you have a single ship, you know, you put all this money to capex at the start. After that, like there's not a lot of, like, it's just operating costs, right? You got to keep the ship maintained, but for a long time, there's just operating costs, which means you're going to get a lot of cash flow. If your whole business is just this one ship, you just put it out in the market and then you're going to run it down to the ground, then your cash flow is going to be comprised of earnings and return of capital, which would be depreciation in this case. So when it's blended, though, when you have all these, like a portfolio or a bunch of boats, you have more than just one ship, then it becomes sometimes difficult to see this concept where it's like, okay, one boat is fine, so I can pay out the earnings and dividends. And if I buy a new boat, I can do it with some debt, which the company has. And it's okay. There's not with certain assets like real estate, you can put on a little bit of debt because it's just a huge asset, and so it's not capital efficient to only use equity. You can earn more if you have debt. If you're smart with debt, you can also blow yourself up with debt, which is why we don't like debt. Um, but again, with shipping, particularly shipping for like you're on the, it's a lake. You're the largest operator of shipping along the Great Lakes. So if there's going to be a call for someone to, to send some money out or to send some product out, some grain or some coal or some wheat or whatever, you're probably getting the call. As long as you have room and capacity, and the right boat, then you should be the one getting that order. Right relationships as well, of course, help. No doubt. You should be the one getting the order. Right. Okay. Interesting. So the company's returned to investors about $370 million in the last 10 years. Now, vast majority is from dividends. So 350 million, 45 million, 345 million is from dividends. Okay, so what was the share price? So maximum. So in 2014, this is where we're looking back. Share price was about, at the end of the year, it's around, come on, where is it? Okay. It's about $16, $17. Let's call it 16. 1650. 1650. Okay, it's just back of the envelope math. So at the time, the equity would have been worth somewhere around 640, 650 million. Let's call it 650 million in total equity. They had a small net cash position of about 30 million. So let's say 600 million equity value that you're paying for, right? 600 million. As an investor, what happened? What did you get? Well, you would have got cash of 350 million. So 600 million. So you spent $600 million buying the company. In the meantime, you took out $350 million. And now you have then you still left with equity worth about 550 million. So you spend net 600 and end up with about 900 over a decade. So what does that look like on a CAGR basis? If we do this rough math, right? Because 350 in cash plus 550 in equity, which is what the current market cap is, 900. So 900 divided by 600, right? Not an awesome CAGR. Just not awesome. It's about 4%. About 4%. So the historical returns are arguably terrible. Right? Terrible. Okay. So the question is that representative of what an investor should expect going forward? And this is what you got to look at is, okay, what's the difference? Like what has changed in the interim? Well, what's changed is you got this these joint ventures, right? So you're buying it under book, and this is an interesting way to think of it. So here's the thing. So think about it this way. In 2014, net income was about $50 million. As we already talked about, your EV, your equity value, would have been about 600 million. So in 2014, you were effectively paying, was that 12 times? About 12 times earnings. You're paying 12 times earnings, right? Paying 12 times earnings. Well, that's not awesome. Today, you are not paying 12 times earnings. Today, you're paying on a trailing basis around half that, 5 times earnings or 6 times earnings. So it's another interesting way to look at it. So the reason, or one of the reasons why you're getting this, or you would have received this, 4% CAGR, which is still positive returns, not the worst thing in the world, but definitely not what you want. It's definitely under. It would definitely be a poor compound return. But essentially, the multiple is compressed. If the multiple had remained 12 times on trailing earnings of 100 million, you got your double in 10 years. You got 7% CAGR on equity, plus you would have got 350. So you would have got. So if it was 12 times this, so current earnings are about 100 million. So you got 1.2 billion. 1.2 billion plus 350. So 1550. You paid 6. That's a 10% compound return over 10 years in a very safe, stable, well capitalized business. So that is interesting, right? Because basically what happened is you had this huge multiple compression, 50% reduction in the value, in the multiple, in the earnings multiple on this business. Huge decline in book value. Huge decline in price to book. Thank you. Hard to English today. Because you're paying 1 times book, then 12 times earnings. Now you're paying 0.75 times book and 5 times earnings. 5.5. So it's considerably cheaper to buy the company today. Considerably cheaper. Which is good. Should the earnings be maintained? Should the earnings not be maintained? Which is possible. Very conceivable. And so at this point, you kind of go, okay, what do you do? Right? Objectively looks cheap on the surface. Historic returns looks terrible to shareholders. They have these, our earnings, like what will earnings be? Right? Back in 2014, it's 50 million a year ish. Between 2014 and 2020, earnings averaged 40 million. And in 2021, 2 and 3, it averaged 100 million. So last 3 years, you've averaged $100 million in earnings, whereas historically, from 14 to 20, you've averaged 40 million. That's significant. So there's another fact to consider. So it kind of boils down to how sustainable are earnings. And sustainable is relative, right? It's still cyclical, shipping still, but it's this. If you're looking at shipping, if you want to be in shipping, it is far less cyclical than, say, container ship ocean going, right? There's less competition. There is less, there's, it's sort of, it's required service. If you need to move grain and iron and coal and whatever fertilizer from the heartlands of Canada, United States to markets, you really can't do it anymore. Like, there's not a more efficient way to do it. So there's going to be traffic. There's going to be trade along the Great Lakes, shipping trade. Now that might slow down, right? That might slow down. Okay. So key questions. What's the economic sensitivity? They're shipping commodities, right? So some of those commodities might have more economic sensitivity, say steel. If you're trying to send iron to steel mills to make cars, you're gonna need less iron in a downturn. Fine, but people don't eat or heat less. Okay, so all right, so here's a question. Google, what are the common commodities? What are the top commodities shipped on the Great Lakes? Oh, there we go. Marine shipping in the Great Lakes. First, okay. 3 main products: iron ore, coal, limestone, farm products. Okay, that's not that's okay. So it's just everything. How credible is this? Clear Seas. Clear Sea Center. Okay. Marine shipping in the Great Lakes. What you need to know. Okay. This looks pretty comprehensive. Are these guys credible? Who the hell are these guys? Supporting sustainable marine shipping. Okay, who are we are? Independent, not-for-profit research center that supports safe and sustainable marine shipping in Canada. Clear Seas established 2014. After extensive discussion among industry, environmental organizations, Indigenous peoples, coastal communities. Okay, impartial information about the Canadian marine shipping industry. Okay, that's useful. Clear Seas provides impartial information on marine shipping in Canada to policymakers and the public. Our mandate is to initiate and interpret research, analyze policies, identify best practices, and share information and facilitate dialogue. Our research focuses on the human, environmental, and economic impact of marine shipping. That includes fine impacts of liquid oil. Okay. Collaborate with Indigenous. Okay. Who's this ED? Okay. Who's this guy? Oh my God. Who are these people? Well, his email and phone number here. So you could like call these people, and be like, if you're doing research, you get deep, you can call these people. Like, hey, I'm doing research. It seems like this is publicly funded. Oh, here's how they're funded. Is it independent organization publishers? Okay. Okay. The organization is funded by governments and industry as detailed in its audited financial statements. Let's look at your financial statements. Who gives you money? Who gives you the money? That is who you have to please. Vancouver Fraser Port Authority, Department of Natural Resources, Canadian Coast Guard, grants. Okay. Okay. So largely the Canadians. Okay. So this is useful. Clear Seas org. Okay. I will buy Great Lakes location, size, facts, and figures. When was this published? Doesn't say. Great. Okay, history of the Great Lakes waterways here. Okay, this is pretty. Okay, this is what we want to know. The Duluth Superior Annual Average Cargo Breakdown from the Duluth source, Duluth Seaway Port Authority. Another great source. Welcome to the Great Lakes Cargo Capital. We move mountains of bulk material, an average of 35 million short tons a year. Okay, 55% is iron, 15% coal, 10 limestone, 10 grain, 10% other, which is fertilizer, heavy lift, liquid bulk, wind energy components, break bulk, dry bulk, bunch of shit. Okay, so this is Duluth. So why are these guys like the... Okay, salt, cement, gypsum, slag, sand, potash, fine. Almost 25% of the Great Lakes marine traffic travels to and from overseas ports, especially in Europe, Middle East, and Africa. Uh-huh. Okay. So a quarter of the volume of the traffic is basically going for international trade. So they translate. So you say they push towards the Canadian Geographic. Man, these guys are really good with their sourcing. Okay, 2019. It's a little old, but probably still reasonably accurate. Years out of date. Tracking cargo. Man. Interesting graphs. Canadian Geographic, fine. All right. Okay. Okay, so here's a sort of existential risk. So this is saying that climate change is affecting the level of water in the lake for two reasons. One, less rainfall, more evaporation, so there's actually just less water in there. And two, water can be diverted. So there was also an article. I think it was chip fabrication in New York State. Chip fabrication, New York State. Micron spends 100 billion to build computer chip factory in New York. Yeah. So there was like a. This is recent. A year ago. And so to produce chips, microchips, costs a lot of energy and costs a lot of water, actually. And so there was I think a CNBC, was there a CNBC YouTube? Micron. Yeah, Micron's 150 billion expansion.
And then in our state-of-the-art facility in New York, when it's fully built out, and for fabs in the US, would use.
The chip costs are, interestingly enough,
like Erie, Lake Ontario, and low-cost power generated primarily by hydroelectric and
Water and power were both big reasons why Micron settled on US expansion.
we have an area plus plentiful fresh water, not just the bigger lakes, but two Great Lakes, Lake Erie and Lake Ontario, and low-cost power generated.
Yeah, so this lady's basically saying that Kathy Hochul, governor, that one of the benefits or one of the reasons why Micron wanted to expand their $100 million facility in New York is that they got access to the Great Lakes. So essentially diverting water from the Great Lakes to produce chips. But if you divert, and the Great Lakes are huge, but that plus climate change. So essentially, it seems like it's already having an impact. Climate models indicate that lake levels could drop as much as a meter, which is huge, and outflows produced by 30% in the next 50 years, 50. Water diversion to areas with drought may further lower lake. Right. So if you're taking water from places, also I think Chicago, Great Lakes water news. Yeah. So in May of 2023, right? Yeah, September 2020, Chicago suburbs running out of water will tap Lake Michigan. Jesus. Right. So Joliet is exhausting its groundwater supply. These guys basically drain their groundwater. And they kept drilling deep layers of the aquifer too salty and shallow, so they can't get more water. So they're going to drain. So they're going to suck it up from Lake Michigan, which just sounds insane. But that's a separate issue. You already ruined the stuff in your backyard. Now you want to, okay, whatever. But yeah, so basically you have things like this. So you have, I mean, these are hard to quantify. But essentially, the point is clear that if you divert water from the Great Lakes, you're going to exacerbate what's already happening with climate change. So as it becomes more difficult for vessels to safely navigate shallower areas like Great Lakes Channel harbors, these vessels, particularly ocean-going salties, funny name, must carry lighter loads to avoid running aground. So less water, carrying less cargo, which means less revenue per trip, even though the operating cost of running the ship is probably roughly the same. Might be less because you're using less fuel or whatever, but generally you still need the same amount of crew to crew the boat. You still need to have the same, financing doesn't change. Like it is a heavy fixed cost business. So if you're carrying less tonnage per trip, you're making less revenue per trip. You are going to make less money overall. Yeah, so even small reductions to lake levels can cost millions of dollars lost to shipping. For example, one study found that as much as 1 meter decrease in the levels of Lake Michigan Lake Michigan, results in a 3.6% to 12.2% increase in shipping costs, depending on the good ship and their destination. So if you lose a meter of lake, you're basically getting a 10% increase in cost. There are conflicting forecasts for great letter water levels. Some models showing water levels rising as extreme precipitation events increase, but the unpredictability is a problem. Okay, so that's an existential threat to be considered. Now, ultimately, who bears the cost? And that's the question. Because if you need to have your corn, like you can't move your farm, right? You can't move your iron ore mine or your coal mine. You can't move large cargo like wind turbines. If the wind is out in the middle of Iowa or whatever, Illinois, you got to get the blades there. You got to ship it by ship. That's one thing, right? Or giant equipment. You can't just truck this stuff. You got to ship it. Okay, so what could the company do? The only thing it could do, or probably one of the main things it could do, is raise prices per ton shipped, or whatever whatever. Effectively raise the cost per ton shipped on the shippers. That would act as a compensating factor, which I think is because otherwise the alternative is that all the shipping companies just make less money, which long term it just doesn't seem like it's plausible. You have the strike, and they're striking for more wages, so costs are going up. Okay, so costs are going up. Okay, costs are going up. Okay. So you get near-term threat is the strike and they get more wages. The revenue loss is going to be temporary, but the wage gains would be longer term. Okay, so it's not so clear. There's some cheapness for a reason, but this is too cheap. How much more? How much more? And then what's the upside, I guess? Maybe that's a better question. What is the upside? How much are they paying out dividends? What do they do? Special dividends. Let's see, special dividends. Special. Okay, so some of the dividend, right? So, well, how much is? What is their regular dividend? Damn it. Okay, so they paid out 50 million in special dividends in 2023 so far. Quarterly dividend looks like 18 cents per share, which is 70 cents, right? So if you're ever looking on Yahoo Finance, which that's a quick one, the dividend you see does not include special dividends. It's just regular dividend. So that 5% dividend is that's just a regular dividend that they're planning to pay out, 18 cents a quarter. Doesn't include it. So, okay. So the question is, what do you get? Why? And then why would you want to do it? And then what's the upside? Where's upside? Where are the sources of upside for this company? Okay. Subsequent to the quarter, the company entered into a share purchase agreement to acquire a minority interest in a mechanical, machining, and fabrication shop, along with the acquisition of its property, with a commitment to acquire the remaining interest no later than 7 years from execution for a total of $16 million minority acquisition. Or is that mostly for the property? They paid out a big dividend. There's about 500,000. Okay, 500,000 share overhang. All right, we're getting distracted. What is the upside? So next quarter, earnings take a bump. Why? because of the strike. So losing money on they can't get cargo, right? So they can't get cargo going. So where is the upside? This is the important question. Where is the upside? Like having it be, less worse than expected is just, it's not a fun way to make money. All right, so let's see what let's see where their money's coming from. Where is the money coming from? Where is the money coming from? This is also interesting. In 2016, an impairment provision was recognized on the self-unloader fleet in the domestic dry bulk segment due to low demand and declining freight rates. This is 2016. During the fourth quarter of 2022, the company completed a review of the market outlook, and it was determined that due to sustained improvement in freight rates, a decline in the shipping capacity on the Great Lakes, and a positive market trends, the remaining provision for impairment on the self-unloader fleet should be reversed. Okay, so that'd be a reversal. Okay. In making this assessment, the carrying value of the self-unloader cash-generating unit was compared to the recoverable amount of the assets. The recoverable amount was based on the value and use model. Using discounted cash flow projections to determine the company's hurdle rate is 8%. 8.01% was derived from the weighted average cost of capital. Interesting. Okay, so they use an internal 8% hurdle rate and 8% WACC internally. What is their cost of debt? They use an 8% WACC. What is their cost of debt? Let's see, it's all over the place. Okay, so, all right, so most of the debt is pretty long term. They got so they have about 400 million outstanding, and 128 million of that amount. Let's see, no more. 120 million Canadian. US 50, so 67 million. Okay, so 128, 67. All right, so just over 200 million. So $200 million plus 47 plus 56, 57. Okay. So of the $400 million, basically 300 million is due after 2030. So they got a long way to go on this debt. So they got a lot of room. And that debt is roughly, it's called 4%. It's like they get to do a little bit less, like 3.6.8, whatever, but call it call 375. Call 375 on 300 million. So 75% of their debt is at 375, but it's due after 2030. They got a little bit due in 2027, and they got a convertible unsecured due in next June at five, but they're paying five and a quarter on that. So $78 million. So they're gonna pay more than that. So they got a lot of room, like a lot of years before they have to, they're gonna have to pay more on their debt. That's good. So the financial structure is pretty well secured. Okay, and what is their financials? How much equity are they using? How much debt do they have? So debt to equity is what? 720, book equity, 400 million. 720, so 140. So 400, 140, 120. So 65-35. So 65% is debt, 35% is debt, 65% is equity, roughly. It's just, and they said there's an 8% whack, right? And I don't see any prefs outstanding. So God, I could do this back of the envelope. Okay, so how much debt they have? Jesus. All right. So it says 1/4 is at roughly 4.5%. 35% is at 3.75. Just make it up. So pre-tax cost of debt, and what's their tax rate? Taxes. Taxes are pretty low. Let's just say for posterity's sake, around 20%. Be a little conservative. Times 1, so equals this times 0.8. Okay, so let's say they're paying between 3 and 3, 3.5. No, 3 and level. Let's have 3.5. But 3.3, 3.13. Let's say that's cost of debt, right? Just make it up. That's your cost of debt. Equals this times this. Trying to solve for 8.01%. Equals this minus this. Divided by this. Does that monkey math work? I think it might. Monkey math work. Okay. Okay, I'll buy that. All right, so we've done some very quick and sketchy calculations, but it looks like if the company is saying their WACC is on ships is 8%, then their cost of equity they're saying is around 10.6%, which, or 10 and a half, call it 10, which would make sense. Because if we go back to that Kager that original Kager formula, or that 10-year period, they would have earned 10%. You as an investor would earn some. You bought a book. So yeah. I mean, it could be just total coincidence, but basically if you bought in 2014 at book, at the same multiples did not compress, you would have earned about 10% between dividends and price appreciation had multiples not compressed. And their cost of equity is roughly 10%. Again, back of the math. So they earn their cost of capital at book value. Margin, if multiples didn't compress, you got your cost of capital. Okay. So it looks like these guys price their assets around 10% equity, return equity for 10%. Return equity cost of equity around 10%. Okay. For us, that's not, I mean, that's our base hurdle. It's our base hurdle. Right? That's our bottom line. We don't want to produce less than 10%. So now these guys are trading at a discount to book, around 75%. So which is not insignificant. It's not insignificant. If you were to make 10% at book, 1 divided by 0.75, right, equals, if you're making 10% at book, or 10.5% at book, and you're at 0.75 book, you're talking, somewhere around 13 to 15%. So about 13 to 14%. Because you're buying cheap. Right. So basically, because you are buying cheap, discount the book. And they seem, at least over the last decade, have hit their earnings threshold, their earnings target. That you'd be able to get 13 to 14%. Again, assuming they actually got their cost of equity. 13 to 40% over a decade. Some of that's going to be dividend, and some of that's going to be come at you in the form of appreciation, which is not terrible. I mean, you shouldn't run screaming into the wilderness with joy, but it is not terrible. Is it enough to do more work? All right. Final thing before we sign off for the morning. What is this joint venture activity? Okay. What are you trading? Furabère, established 2020. The ocean cell phone loaders, global short sea shipping. Nova Algoma, a joint venture between Nova Marine Carriers of Switzerland and Algoma. Partnership consists of 3 fleets, including cement carriers, handysize, and mini bulkers. Okay. CSLI International Self-Unloader Pool. Algoma participates in the pool with our long-term partner, CSL Group. Algoma owns 8 vessels out of the 18 operating the pool, with 2 methanol-ready Camsar Max Ocean self-unloaders currently on order. Okay. So they're carrying cement and handy-sized bulkers. Feuerbeer, Algoma and Fuer Tank entered into agreement to build 4 dual-fuel, climate-friendly product tankers by November. Investment was doubled to 8. Okay. So we got a Swedish JV, which is relatively new, to move. That sounds like fuel or fuel product, petroleum products. We got cement. Joint venture revenue. Interesting. Okay, so they give pretty good disclosure. So, global short sea shipping, which consists of their joint ventures, focus on niche marine transportation markets and geographies featuring specialized equipments or services. Cement carrier fleet comprising pneumatic cement carriers servicing large global cement manufacturers that support infrastructure projects. The short sea mini bulker fleet comprises owned ships, chartered vessels, and vessels operating on third-party management contract fleets supported the agricultural, cement, construction, energy, steel industries worldwide. The handysize fleet is an opportunistic sale and purchase vessel platform. Okay. So it sounds like some might be longer term relationships. Some is clearly this handy size fleet is clearly maybe more spot market. Opportunistic, we call it opportunistic. Freight revenues in this global short sea shipping is 278 million, which means it's a sizable operation. Their overall revenue, which does not include this amount, is only 723 million. The equity earnings is 50%. It was so. So this, wow, that might actually be a really good business then. So their 50%, almost 50% of this business is $30 million in equity in 2022. That's half. So that means it's 63 million. But the freight revenue, which is 100%, is 278 million. So that margin is like earnings. It's like almost 25%. So they crushed it on this business in 2022. Like huge. Okay. Okay. And these earnings, I mean, they've ramped up huge. Question is, I guess, not how much FX some gains on disposal, but it looks like it's mostly coming in lower operating costs and a lot higher revenue. So I guess they're getting better rates. Lots to investigate. All right, so the question is, we're going to sign off here. The question is twofold. One, basically, it's at this point you want to like it's no go no go no go no go. Do you do more work? To determine if you want to do more work, you gotta think about what's the upside, right? Because the downside in this business, it looks fairly well protected. You're at a significant discount of book value. Company's performance historically has been good. It's cyclical because earnings are quote volatile, but they're cyclical because it's a shipping business. But that's fine. You're gonna have great years and you're gonna have bad years. So from here, where's your upside? Okay, let's say you get a little reversion to mean, little return to book value. You got these joint ventures that might, are they pumping out again? Are they at cyclical peaks? Basically, are you buying at a cyclical peak? And if you are, how much lower do you go? And if it's going to continue, do the market even care or recognize that? Because you're getting a 5% dividend, and they clearly pay out specials. So you're not going to be left stranded holding just the equity. You're going to get cash. All right, well, something to think about. We'll see you guys tomorrow.